and welcome to Mint. I am Nasrin Sultana. Indian markets are looking forward to the new government led by Mr. Narendra Modi. However, markets are facing a lot of challenges as there are multiple earnings downgrades, there is a liquidity crisis, and overall there is a consumption downturn. So to take us through what's the market's way forward, I'm joined by Mr. Harsha Upadhyaya, who is the CIO Equities of Kotak AMC. So Mr. Harsha, welcome to the show. My first question would be, what is your outlook on the markets right now?
We are constructive on the markets. We believe that the mandate given by Indian citizens for the incumbent government to continue ruling the country, I think that's a very big positive. There will be policy continuity, there will be policy stability, and also a lot of things would be predictable for markets. So that's the biggest positive. Yes, there are issues in the economy which are more medium-term oriented or long-term oriented. So to that extent, I think we can expect policies from the government to address some of those issues. But overall, we believe that the bias in the market would be very positive.
Right. So as you said, few initiatives of the government which may kind of boost the market forward. According to you, what would those be?
I think clearly there has been a framework that has been laid out by the earlier term of the government. I think the focus was on giving macroeconomic stability by targeting inflation, having a national indirect tax system, which is GST. And also there was a lot of work done on IBC, Insolvency and Bankruptcy Code, which kind of smoothens the entire process of resolving some of the bad assets in the corporate sector. So many of these issues have already been kind of addressed, and we need to build on those. I think clearly government's initiatives would be to boost investments either through private or private-public partnership, and make sure that the investment cycle is very strong. Because for the last several years, we have seen very, very muted investment growth, and the entire economy has been supported by more of consumption growth rather than infrastructure growth. And we believe that renewed focus will come on creating that infrastructure side. And those policies will help the entire investment cycle-led sectors. For example, engineering, capital goods, cement, many of these sectors. We can also expect continuation of reforms on the taxation side, both on the indirect taxation as well as on the direct taxation. We also expect some amount of focus coming back to agricultural side of the economy, because that's been struggling for some time. And also if you address some of the issues that are there in the agricultural sector, it can give a fillip to rural economy, and hence the consumption slowdown that we have seen recently can also get addressed. So I think, and one more initiative could be to make sure that since globally there has been a disruption because of the US-China trade war, can India gain in terms of global export share? I think that is something which is more of a medium to long-term policy initiative that we can expect government to address.
Right. But at the same time, as you sound very positive on the markets, we are also struggling to come out of a liquidity crisis which have been haunting corporates. And there are, in the earnings that has gone by, there are a lot of commentaries saying that because of liquidity crisis, there has been difficulties in conducting business. So do you see the government tackling the liquidity crisis immediately?
Yeah, I think that will be one of the immediate focus areas for both RBI as well as government. I think NBFCs stepped up their credit to economy when PSU banks were struggling. Right. So in effect, the economy didn't suffer much because of the lack of credit that came from public sector banks. Somebody else stepped in. Today we have an issue where NBFCs, or most of the NBFCs, have been struggling for low cost of funds and availability of those funds. So I think if you need economy to move along smoothly, there has to be a multiplier effect, and that has to come from the improvement in credit terms, and NBFCs play a very, very large role in that sense. So I think we can expect, already there have been a couple of policy initiatives, and we can expect some more to come over the next few months.
Right. there is also an slowdown in the consumption. Does it worry you, because FMCGs or the autos, they have shown a slowdown, and they kind of show they are concerned that it may go ahead. Does it concern you?
It's a concern, but we believe that at this point of time, it's more cyclical in nature rather than a structural problem that our economy is facing. We had seen a significant amount of growth in the last 5 to 6 years in the entire consumption basket. I think that cyclical downturn is playing out now. And to an extent, the ailing rural economy or the infrastructure inadequacy that is there in, for example, in the metros, are all playing some part in terms of slowing down the demand. And also the recent fallout of the NBFC fiasco has had an impact in terms of availability of credit that was going to some of the consumption demand. So I think it's a concern at this point of time. And hopefully it's more of a cyclical in nature rather than a structural one, and that's what we believe.
Okay, so we are almost at the fag end of the earnings, March quarter earnings. What is your reading of the earnings of the March quarter that has gone by?
It's been a mixed one. I think initially it started more or less in line with expectations, but towards the end there have been some misses, and usually that happens because some of the backbenchers usually don't come out with good set of numbers. Having said that, I think all eyes are on financial year 2020 earnings rather than what has happened in March quarter. That is where I think market still is expecting 20% plus kind of an earnings growth on a year-on-year basis. And a large part of that, nearly 55 to 60% of that, is going to come from earnings growth from corporate banks, where we believe things are holding steady, and it should continue to deliver those kind of improved earnings. But what is worrying at this point of time, as you mentioned earlier, is the slowdown that we have seen on the consumption side. And if it impacts earnings, then whether the 20 or 21% kind of earnings growth that market is expecting, whether that will come through or not is still a question. I think a couple of months down the line, we'll have a clear view on that.
So considering we take out the financial earnings, as you said, it will be led by corporate banks. But besides that, do you see an exact revival in the earnings in FY20?
I think the revival in earnings is already in place. I think most of the banks are doing well. Cement is doing well. While there has been a slowdown, even FMCG has delivered in the past, and will continue to see reasonable amount of earnings growth from FMCG as well. IT will deliver market average kind of earnings growth. So I think there are pockets which are doing well. Yes, there is a problem in maybe NBFC segment or autos and a few other parts of consumption. But overall, I think, we should still be looking at maybe high teens or close to meeting expectations in terms of earnings growth for financial 2020.
So in this scenario where we are looking forward to a new government, in the global scenario, there is a slowdown and there is a potential trade war between the US and China. How does that impact India, and especially FI money, because India is part of the EM basket, and FI money, of course, is kind of impacted by such kind of events?
No, I think it has actually been a boon for India. Since emerging market growth has been better than what the growth for the developed markets would be, and also there is easy liquidity because most central banks are going with a benign approach to interest rates. Money has shifted from developed markets to emerging markets, and that is still continuing. And India has also been a beneficiary of that. We have got close to about $10 billion this calendar year to date. And all this happened mostly before a government was formed. And now with a stable government, which is likely to be in place for next 5 years, and expectations of policy continuity and stability, we believe that the foreign institutional investor interest in India should continue at higher levels. So I don't think there will be worry on that account at this point of time.
So my last question is, I'm very tempted to ask, what happens to DI money, because they have been net sellers and they have been very erratic. Not as much robust money as we saw in 18 and 17. What is happening in the DI side?
In terms of the retail interest, yes, from the peak levels of net inflows of about 18 to 20,000 crores, that number has come down to about 5 to 6,000 crores a month now. Our expectation is once the political stability is clear to investors, I think slowly the redemption numbers would go down, because the gross numbers have not changed, but there was net redemption happening in some of the segments. I think that should come down, and eventually we should see better numbers for domestic flows as well. And once the flows come into mutual funds, obviously beyond a certain cash level, you will not expect fund managers to keep, and that money would get invested into markets.
Thank you, Mr. Harsha. That was insightful. So, Kotak AMC expects the markets to be bullish by this year end, and they also see an earnings upgrade by FY20. We will keep an eye on that. That's all from now. For more details, stay tuned.